G'day, welcome to Lunch Money. My name is Nick Samios. I am the Director and Fund Manager here at Hermes Capital, and I am your Lunch Money host. Now, I have to tell you, normally I've got a whiteboard just over there, and normally on that whiteboard I have some points to sort of remind me what to say, and et cetera, et cetera. But today I have to tell you that I've drawn a mud map of an intriguing corporate finance emergency. And as I say, it is a web of intrigue, and I did this big mud map to explain it to all my staff. But I'm not going to share that with you because I don't want to end up in court, but certainly there's some fascinating stuff going in the news right now. Now, as you know, Lunch Money is the online and social media home for special situations, workouts, and capital raising professionals. And one of those special situations is mergers and acquisitions, buying or selling businesses. And so today we are focusing on buying and selling businesses, M&As. Is it a seller's market? That's the question I've got. There's a lot of money sloshing around the capital markets, as you know. We've had various economists and experts over the past few weeks since we kicked off in 2021 talking about that very feature. Interest rates are super low. Surely now's a good time to sell your business. And one of the ways of selling businesses is via a trade sale. So I thought that we'd specifically talk a little bit about that. Before I introduce our two guests today, however, I will do the customary reminder to share, like, or subscribe our podcast. And if you, actually, I'm mixing it all up, aren't I? Firstly, share, like, or subscribe our podcast, please. Help us to get the message out and make it more engaging when more of your colleagues watch and ask questions, etc. And when they do ask a question live, then I'll send them one of these wonderful Lunch Money mugs. It is a mug that keeps your hot beverages hotter, and it makes them more nutritious. Plus, it's very stylish to sit in your office drinking with one of these. Okay, I think I've done all the housekeeping. It's now time for me to introduce our first guest, and that is Andrew Cassin. G'day, Andrew. How are you?
I'm very well. Yourself?
Very well indeed. So Andrew is from Succession Plus. His primary focus is on the sale of privately held businesses valued between 1 million and 100 million, predominantly in service industries, including health and allied care, recruitment, labour hire, etc., etc. I've known Andrew for some time. Firstly, tell me, Andrew, as a business broker, what is it that's been keeping you busy this week?
Well, there's a lot of, now that we're past the COVID lockdown stage, there's been a lot of pent-up demand for services and for people really considering the sale. So there's been quite a few inquiries from business owners who are looking at selling. Had some inquiries also from people looking at buying. Been really busy pushing out a couple of the opportunities we're working on at the moment. Working on it with those, trying to coax out a couple of offers, which are due any minute now, which will be fantastic. And also doing some coaching of one husband and wife team who are running a business, which is always interesting. And we've just started on a buy-side engagement as well. So working with a buyer who's identified a couple of acquisitions they want to do. So it's been a busy week, and here I am talking to you on a Friday afternoon, which is a lot of fun, actually.
Excellent. A couple of things that you've said there. One is that you're coaxing offers, and in sort of preparation for this, I thought that we might tease out some trade sale stuff. So I guess we'll get to that. I imagine that coaxing offers is part of the trade sale process, but you also said that you've taken on a buy side engagement. So yeah. What goes on there? It's someone who's looking to make organic growth is stifled, and they're looking to grow by acquisition, or what triggers that?
Well, it tends to be growth by acquisition. A lot of business owners end up with excess cash, which is a nice problem to have, and they need to deploy that because it's no good sitting in the bank. So they look at growth, particularly when they're growing towards their own exit down the track. So this particular situation is one where the business owner has come to us and said, I need help. I identified a couple of opportunities. I've negotiated basic terms. I need someone to advise all the way through from this point. So we draft the term sheets, put them in front of the vendors, negotiate final terms, then we'll undertake the due diligence process on behalf of the buyer. and then run the process of getting contracts drawn up once we've got all that finalised.
Now, interesting, usually business owners, sort of got pretty good opinions of themselves. I mean, that's why they're business owners. And they, one of the traps that people fall into, of course, is thinking they can do it all themselves. So what is it that compels them to come to someone like yourself to, as opposed to doing it themselves? So what is it that gets them over that line, that the realization? Is it a confidentiality thing, or is it, as you said, you mentioned documentation and that sort of stuff? I mean, what is it that compels them to come to you as a professional?
Are we talking about buy side or sell side?
On the buy side.
Buy side, time, a lot of it, and also a lack of expertise. It's a complex process. There's a lot of traps, a lot of pitfalls, and there's a lot of money at stake. And one of the truisms of the M&A market, and if you read any research at any time around the world, it'll say 80% of acquisitions fail to create shareholder value. So anybody who's going to engage a professional to help them, they want to be one of the 20% where the acquisition is going to create shareholder value, not destroy it.
Yeah, that's interesting. I suppose we all want to. Yeah, we all want to be one of the 20% successful ones, don't we? Yeah. So that's So I guess So obviously you're getting stuff that crosses your desk, but even if it's not something that's on your desk at the moment, then you're able to identify who to approach and all that sort of stuff.
Correct. Yep.
And okay, all right. Well, look, what we'll do is we'll get into some nitty gritty in a minute, but first I'll just introduce our next guest, who is Matt Adams. G'day, Matt. How are you doing?
Good, Nick. How are you? Thanks for having me on.
Very good. Now, I've got Matt as the Managing Director of Dynamic Corporate Investments. He does wear a number of different hats, but he's an experienced financial advisory professional. He specialises in restructuring, governance, risk and transactional matters. And I was saying to Matt a little bit earlier, I mean, I know him more as a sort of a corporate advisor / professional director and on the capital raising side, but you've also got a restructuring background. So with all of that going on, what is it that's been keeping you busy lately?
Yeah, good. So really, two things this week. Actually, we've got and dovetailing into what we're talking about today. So I'm a board member of a listed hospitality group, and that's on the acquisition trail, and we're pursuing half a dozen or so venues at the moment, and some of them more progressed than others. So we're in DD on a few, and really chasing the others. But we're a company that's sort of on that growth path, but obviously need to keep yourselves very disciplined, et cetera, in what you actually purchase and acquire. So that's been keeping me busy. And then I'm at the tail end of a large renewables restructuring that we did last year, and that involved a business that was in some form of a distress, but had a great underlying business. And the restructuring really involved some operational turnaround for it, but then also introducing some new equity stakeholders that were backed by private equity. And this week I've just been sort of finishing up the tail of that.
I guess in the restructuring world, particularly as you sort of get more into that middle market space and out of the SME space, some of these corporate restructures and turnarounds do often result, obviously, in a divestment, but they can also result in getting into the acquisition path as well. Absolutely.
And look, a restructuring is a very, very wide word, and it could mean anything. But if the bones of the underlying business are good, then absolutely using a restructure to right size the operations and restructure the balance sheet, and then putting it on a growth path, which often does include acquisitions, is actually part of that and can be very, very successful.
And do you think? I mean, would you agree? Obviously, there's a surplus of capital about, with the low interest rates and governments all around the world flooding the market with cash to try and keep the patient alive. So there's a lot of money around. I mean, is it fair to say also that we are in a low organic growth environment? Really, I mean, you'd expect M&As to really feature again prominently this year.
Absolutely. And what I will say about that, and I think your comment just then, Nick, about there being a lot of cash around and a lot of appetite is absolutely true. What I will say is that a change that I've certainly noticed in the last, say, 12 months or so is, though, that cash is becoming more disciplined, and especially going through the sort of DD process and what assets they are prepared to invest into, et cetera. is becoming more disciplined, and therefore you have to match that discipline on the other side of the transaction as well.
Yeah, I mean, you say that. I mean, I'm sure that there is discipline, but there's also a lot of competition for deals. Would it be fair to say? I mean, as I say, the deals that I've seen, you're never the only bidder. There's a lot of people bidding for these things, and I guess while there may be discipline around caution, certainly hurdle rates just seem to be falling away. Would you agree with that?
I absolutely would, and what I think it means is that we've almost got a two-speed, I guess, M&A acquisition sort of environment at the moment, and those assets where there really isn't any value or there's no upside to them or whatever, I think they're potentially finding it hard to attract capital and even debt. On the other side, though, those good underlying assets are much sought after. You're right, and there's half a dozen people fighting over them, and what that's doing is just compressing the multiples, etc.
Yeah.
Okay.
All right. Well, look, we will bring Andrew back, and we'll sort of get into the topic of the day. So, Andrew, to what extent a trade sale? So, obviously, there's a number of different kinds of M&As. There's a PE firm buying a business, for example, but another, or just a professional investor or someone just looking to get into business. But another major form, obviously, is the trade sale. I mean, is that what portion of your business would end up being trade sales?
Without putting an actual figure on it, I'd say it's definitely the majority would be trade buyers. I think what you were saying before is right. Inorganic growth is tough. So when there's cash around, and cash is cheap at the moment, so if you can access it, the way to grow is to buy, a competitor, someone upstream or downstream from what you're doing. A business is going to allow you to grow without, without cannibalizing your own market, really.
And okay, so what when you've got someone, say on the sell side, coming to you looking for thinking that they might be looking for a trade buyer, what are some of the steps or tips? What are some tips that you have for them?
Well, typically the rules are the same whether you're selling to a strategic trade buyer or you're selling to a financial buyer. You've still got to make sure that the business is well set up as an asset and that it's going to stand out as an appealing asset in the marketplace. I think that's one where a lot of business owners fall down in the process, is that the business is worth a lot more to them than it is to anybody else. And they don't have the ability to step back and look at the business objectively and really determine how appealing it might be to someone else. I think there's an underlying assumption that someone's just going to come along and write a check and they can scoot off into the sunset without any hassles, and that's just not the way things work. So when you're getting ready, or you want to be appealing as a trade option, or as a sale in general, you've really got to make sure that the business is no longer dependent on you as the business owner. That's absolutely critical. And even Michael Gerber talked about that back with the E-Myth. You're going to be working for the business, not in the business, and that's truer words have never been spoken, really, when you're trying to prepare for sales. So you've got to get out of the business. Secondly, you've got to make sure that you're not overly reliant on one or a very, very small number of clients, and that even those customers have got to be, it's got to be an appealing profile. We've got one client at the moment that's very, very difficult to move because 80% of their business goes through Bunnings.
Yeah.
Now, that's wonderful, and the business performs in a way that suggests that it is wonderful, but no one else will touch it because that relationship it's very, very heavily concentrated on that relationship. And there's a risk that if something went wrong, if the contract was pulled, then there'd be no business. So, whilst the business itself makes a few $1 million a year in profit, and they do very well, it's too risky. And the final, what I call the big rocks, really, principal dependence, customer dependence, and the final one is systemization. That's that knowledge capture.
Yep.
Anybody who's going to buy a business is going to be assuming that all of the key people in the business will leave. And if they're not assuming that, then they're not going about the acquisition very well. So what they're going to be looking for is the extent to which knowledge is captured in the organisation through systems, processes, workflows, automation, databases, so that, day one when they own the business and half their staff walk out, then there's got to be a process for how they then attract, recruit, train, remunerate people, onboard them, and the business can keep on, keeping on, business as usual.
Okay, well, all right. Well, you've given us quite a bit to unpack there, Andrew. There's a lot of bullet points there. So, Matt, where would you like to dive in? Andrew started off by saying getting, I guess, firstly making sure that the business is presentable, I suppose. I mean, as someone who's acquired businesses, I mean, what are your comments there when you've gone in and it's just not been ready?
Yeah, look, I mean, just to start with, I think maybe a slightly different way to put what Andrew said is, from a purchaser's point of view, what a purchaser is prepared to pay is generally, it's generated by risk, and so the more risk there is to any one of those matters that Andrew raised, or any others, frankly, will drive down the multiple that a purchaser is prepared to pay. So as a sort of business owner getting ready to sell, and obviously the business owner's advisors, de-risking as much of those things as you can will frankly get you a better multiple. And that's what your ultimate objective has to be. But certainly of those things that Andrew pointed out, all very, very important. I think the reliance on an owner is from what Andrew just said then, in my opinion, that's probably the biggest thing. And there's a lot of potential acquisitions in various sectors and in various roles that I've had that I've kicked the tires on and walked away from, just because I haven't been able to get comfort around the fact that the business isn't, wholly or materially reliant on that owner, whether it be from an operations point of view or a key customer contract point of view, et cetera, et cetera. So being able to take out that risk is I think, very, very important for business owners.
Yeah, I guess, when you sort of look at the textbook, the value of the business, it's either an EBITDA multiple or it's, you're applying some sort of IRR, expected return. And I guess the lower the risk, then the lower the expected return that's required, or the hurdle rate that's required. I guess, Andrew, because you were saying that, I guess there's a couple of key risks there. I mean, I've looked at businesses where 80% of the business is one customer. I mean, is that even really a business? I guess is one of the questions. And how does a diverse customer base affect the multiples?
Well, yes, it's a business. It's definitely a risky one, because if you lose that customer, then your business probably doesn't have much in the way of legs. We were dealing with a transport company that had one client, and it was hauling dangerous goods, and it was effectively seen as the transport division of that client. But again, that was seen as just too high risk, because if that relationship broke down because the owner was no longer there, then there wouldn't be a business left, even though they'd have 30 odd trucks and pieces of equipment. So it's a real concern. And when you're de-risking the business, to Matt's point, that's going to be one of the key areas you're going to be looking at, making sure that you've got a good spread of customers, or if you do have a big customer alliance like that the contract that you have to provide services is pretty ironclad.
Okay. And what about, you mentioned before, balance sheets. I mean, I've said a number of times, we are in a bit of a two-speed situation where balance sheets of some businesses, the debt's been paid down. I think there was a statistic where there's $250 billion, I should say, in household and business savings, in savings accounts, and half of that is in business savings. So 125 billion of in business savings, which is massive. I hope I've got my millions and billions worked out correctly there, but it's a lot of money. It must be the billions. It's a lot of money that's sitting in savings accounts. So there are some businesses that are well cashed up. they've paid debt down, and presumably if they've got balance sheets with some real assets on them, then they're in a position where they can leverage that. I mean, and then of course on the flip side of that, there's businesses that maybe have gone a few rounds of the kitchen and don't have any capacity, and they're looking to sell. I mean, what's the availability of finance like, Matt? I'll go with you. I mean, what's the sort of, how are you finding banks when it comes to raising capital for the purpose of an acquisition, if in a trade sale scenario?
Yeah, look, I think that I don't think that there's massive problems with that at the moment. I think there is some conservatism that's sat there for the last sort of year. But I think for good assets, and more importantly, good customers, there's certainly that availability there. Now, whether that's always the banks though, or then you move into the sort of shadow banking industry and, private equity capital and private capital, etc. I mean, I think if you put all those together, especially sort of at that mid-market and above, which is easy to access that non-bank finance, then there absolutely is the capacity there. In saying that, once again, the same as we talked about now, vendors have to dress up their business for sale and do the proper things. Purchasers as well have to be able to very articulately put their finance application together, etc. And look, from where I sit, where that sometimes falls over is, once again, businesses that don't want to take advisors on that know what they're doing in that, and then it gets a whole lot harder to access that capital. But certainly for the right opportunities, we're seeing there is appetite there for capital. Interesting enough, we had some assets in the event space last year that we dressed up as quite a big player, and we sold them. And when we sold them, that was the access to finance and all was a little bit under pressure. We actually negotiated a term sheet as, in effect, the vendor with an external financier. That obviously wasn't binding, but was able to be given to potential purchasers, along with the IM, etc.
Wow.
Which made the sale of those assets easier, because we gave them a financing solution if they wanted to take it. Now, it turned out the people we ended up selling it to didn't take advantage of it, but it certainly helped competition in selling those assets, which obviously drove up the price somewhat.
Yeah. Okay. Listen, we've got a question here from one of our loyal viewers, Kenel Tonkin, who, funnily enough, his business is called Systemize to Grow. So obviously our show today is right in the zone for him, and he's asking here, and I'll put this to you first, Andrew. How much can a business owner improve the multiple his or her company can achieve if A, key person risk is removed, and B, customer concentration risk is removed? So I guess, looking at that scenario there where there is a heavy concentration to a customer or a key person, I mean, how does that, in your experience, affect the multiples? I'll come to you first, Andrew.
Again, you can't really put figures on that. Ultimately, what a buyer is looking for is sustainability. And the first thing you're going to look at is the key person risk and then the customer concentration risk. So the higher the risk profile, the lower the multiple. Now, we're typically looking at multiple ranges in that 2 to 5 times EBIT sort of range. And if the business is heavily key person dependent, heavily customer dependent, it's going to be down the bottom of that range, that 2 to 5 times EBIT range. And if those things are removed, then they're going to be heading up, north of 4 times EBIT. So you could effectively double the value of your business by removing the key person risk and the customer concentration risk, if you do them right. It's not just, this isn't about just painting the walls and putting new carpet down in a house to sell. The business itself still has to be fundamentally sound and performing and productive, because if the person who's buying the business is buying an asset that is going to keep on generating cash for them, and hopefully some cross-selling opportunities, so they get some synergies out of the purchases as well. But to answer the question, you could effectively double the value of the business if you remove those,
wow,
depending on where you're starting from.
Yeah,
there's a lot of depending ons that come into that, to answering that question.
Sure.
But if I'm assessing a business, that's what I'm going to be looking at.
You mentioned before, Andrew, I'll just stick with you on this point. You mentioned before that some of the stuff that you're doing lately is coaching. I mean, is this general business coaching, or are you coaching towards preparing for sale? And is this the sort of stuff that you talk about?
Sales. So you do a diagnostic of a business and see where the gaps are, and particularly this key person risk and customer concentration risk, and how well their financial management is set up. And this particular client that I'm working with at the moment, their accounts are a bit of a mess. So we've got to make sure that they get fixed up, because the last thing you want to be doing is showing that to a potential buyer. They'll run a mile. But also just making sure we've got enough time ahead of us so that we can show a good solid 12 months of trading with different disciplines in place, like a budget. They have never operated with a budget. So we're going to be putting that into the business, and so we can start tracking against a budget. It sounds really simple to people who are in that game, but a lot of business owners don't know what they don't know. They don't realise they need them. They don't realise how much value they can add.
Yeah. Okay. What do you reckon, Matt? What are your thoughts there?
No, I think. Look, in terms of the question, I think I echo Andrew. I was probably even going to be a little bit harsher than that and say, if a business has massive key person risk and massive customer concentration, a business like that, I think you're probably lucky to get 2 times at that point. So I think that there is massive upside in addressing those 2 risks. But as Andrew says, it has to be done over a period of time. It's not just painting the walls. It really isn't. And look, I think that the businesses preparing themselves for sale, working with a trusted advisor over a number of months or years to prepare that business for sale, you're going to see the value uplift in multiples, will be massive.
All right. Okay. Well, look, we'll say thank you very much, Kenelm, for your question. And Kenelm is a chap that I met many years ago when he was a conference organizer. Since then he's been to New York, and he's back in Australia. So one of these days, Kenelm, I would love to get you on Lunch Money, because I'm sure you'd have lots of very interesting stuff to share.
One more thing to that answer that question, and I think Matt's sort of heading this way, talk about being brutal. But I think the difference is really, it's not even about multiples. It's about how is the business actually sellable?
Sellable, yeah.
Yeah. And if it's got a high key person risk and high customer dependence, it's not even sellable. So your market value is effectively 0. It's a 0-time multiple. It's not even 2 times.
Yeah, right. Well, nobody likes that. Telling someone, yep, your business has got a 0 times multiple. Okay, well, the other sustainability is obviously, if it's, because it's I guess how many years into the future you think you can lock away that income. I was watching, I can't remember if it was Bloomberg or one of those share trading investment YouTube shows, which I've got in my system at home, and they talk about moat, which was this new concept that I hadn't heard of before, but you guys probably, so you're nodding your head there, Andrew. Yeah, this concept of how many years of sustainability you have. But look, we won't get into that. What I'm interested in, since we've got you, Matt, and since you do have a little bit of an insolvency background as well, do you, in all of your insolvency friends, and I guess your insolvency side of your business as well, there's obviously no insolvency really going on at the moment. But I would have expected going into the beginning of COVID, that there'd be lots of opportunities for businesses to exit, and there'd be a lot of distressed sales about. I mean, is that something that's on your on your projections this year? Is buying distressed businesses, or do you think that that's not going to happen for another little while?
Yeah, look, it's interesting. I think that the opportunity is absolutely there, Nick, and it is. And what I'll use as an example for that is the hospitality business I'm in, and as I've already said, we're on the growth path there. But this answers your question, I think. I think there is absolute opportunity to acquire distressed businesses, and we're certainly looking for those sort. And on the other side of my business, I'm actually working with some distressed business at the moment in divesting or getting value out of it, etc. So I think that there is opportunity there. I think what everyone needs to be very, very careful about, and sort of talking to equity owners and all about this, is where it is sometimes lost is, there is a difference between a business that's really just been hanging on through COVID and probably wasn't much to start with before COVID. And whilst there's absolute interest in good assets at the moment, or underlying assets, I think that those sort of assets are going to find it hard to find a home, quite frankly. In saying that, once again, distressed businesses that can be restructured and good underlying businesses, there is absolutely opportunity there, and there is a plethora of sort of opportunists and others out there, looking for those opportunities. And the key is to sort of hook them in, but then work in all the things that the three of us have just spoken about to make those assets as attractive as possible to get the highest possible price for stakeholders at the end of the day.
Okay. Now, look, I've got 3 more questions I want to get through, and we don't have a lot of time, so I'll just lob these at you and see what you come back with. I've got the first one is my question for you, Andrew. How often do you have a situation where someone's bringing you a business to sell? And, the question is, are they looking to really get out of how do you differentiate between something that's a hospital pass because they just need to get out because otherwise they're going to go broke versus, someone who's genuinely looking to retire or move on?
Over the years, it's got easier. That's probably the best way of answering that, Nick. Initially, I probably wasn't even that discerning about the clients I brought on and paid the price down the track.
Yeah.
But one of the big questions that I ask people is, what are you moving towards? What are you going to do next once you sell? And if they can't answer that question, it's pretty clear that they're in a bit of a mess and they're trying to move away from the business rather than moving towards something new. So that's one of the joys of dealing with the people who are actually genuinely retiring. A lot of them have got quite a bucket list.
Yeah. It's interesting. I was looking at a business for one of my family members, and it was I won't say what it was or where it was, but when you looked it was through a business broker in Queensland, and when you looked at it, you realise the sister was working in the business and probably for nothing. Once you put some real costs into the business, it really wasn't a business at all. It wasn't going to survive. That was a distress scenario. Listen, I won't ask you that same question, Matt, because I've got another question for you. I don't know if through your travels, if you've met Paul Mazzola. He has been on Lunch Money before, and he was a senior corporate banker maybe a decade or so ago. He's now at the University of Wollongong, and he asks this question: if vendors are offering their business for sale together with a lending package from a bank, which I think you alluded to a bit earlier, to fund the acquisition, then how does the bank price the loan in advance without knowing the borrower?
Yeah, absolutely. No, and a great question, and something that we deal with. And I must admit, the example I used before, the financing package didn't actually come from a bank. It came from a private equity fund manager. But in saying that, what you put together is it's a conditional finance package to start with. It's high level terms, and it's obviously subject to DD, etc., from the financier on the incoming purchaser. So it's not a here's a ready-made solution, but it's more there's a solution here, but you may have to jump through some hoops and meet some hurdles to take advantage of that. And pricing, etc., which is a good question. Pricing was expressed as a range, both in terms of straight pricing, and there was also some equity kickers attached to this for the financier coming in.
Right. Okay. All right. Well, hopefully that answers your question there, Dr. Paul. Thank you very much for putting it up. Now, I've got just 2 more areas I wanted to very quickly touch on. Andrew, I'll start with you and then I'll get your feedback. Matt, what are your thoughts on vendor finance, and how often would you encourage the vendor to sit on some of the price? So do you have a general philosophy or feeling towards that?
Vendor finance, I'm not generally against that. I'm more against earnouts than vendor finance. So deferred payments that are linked to achieving certain KPIs. I've just seen too many situations where that's been manipulated by the buyer so that the vendor doesn't get any future payments. So vendor finance is fine as long as they're the only lender. The biggest problem comes when the buyer is getting some acquisition finance and they want vendor finance terms, and then you get into this, well, who ranks higher argument.
Yeah, I can answer that question. It's me as the lender, but That's always a very easy answer, a question for me to answer. What about yourself, Matt? I mean, I think the interesting thing about vendor finance is, particularly where you're dealing with a higher purchase price, it does keep the vendor honest, for want of a better word, I suppose, in making sure that the value is realised. I mean, what are your thoughts?
Yeah, it's an interesting point, because I think I absolutely see where Andrew's coming from, and from a vendor point of view, I agree. When he used the word earnout, my ears pricked up a little bit. There's two transactions that I've been involved in the last year where there was I guess it was very, very hard to get to a meeting of the minds between the vendor and us as the purchaser on price. And both those transactions, we actually ended up doing deals with earnouts in there. And I absolutely think there is the risk, exactly as Andrew set out. But what we said to the vendor is, well, look, you want your 4 times multiple or whatever. We don't see that because of this, and this, and we're only prepared to pay 2.5 or whatever. But how about we lower that 2.5 a little bit, and we'll give you an uplift on an earnout that makes sense based on what you're telling us is the reason why there should be value there that we can't get certainty around over the next 2 to 4 years or whatever it would be. So I think that's where an earnout possibly can be somewhat beneficial, and shouldn't hurt the vendor too much, because what we as the purchaser were saying is, we're not going to give you 4 times. You're not getting. If you want cash up front, you're not getting.
Okay. Listen, Warren Henry from WA, and I will be in Perth next week. So hello to all my Perth friends, providing the borders don't slam shut between now and then. I hope I haven't jinxed it. But Warren asks, do you see the sale of service industry businesses more difficult in the current environment? Just quickly, Matt, I'll start with you.
No, I don't think so. But the but, as there always is if the business hasn't been performing for whatever reason, if it's gone through a COVID slowdown or shutdown or whatever, well then, I mean, that obviously raises questions to value, etc. And then you also bring it back to all those issues that we've talked about before, being key man and all that. But I don't think it's more difficult. I think that those businesses can be difficult to sell, full stop, if they're not set up properly for a sale.
Okay. Andrew, quickly.
It's a pretty good answer from Matt there. I think if they're not well set up, they're destined to fail. But it really depends on which businesses within that whole service sector. Accounting firms, you could list one today and it'll be gone tomorrow. Financial planning, there's buyers lining up for those sorts of businesses at the moment, surprisingly. But can you sell a white collar recruitment company? Probably not. There's a lot of demand for those at the moment. So irrespective of how well set up they are, those particular businesses are, there's just not the buyers there for those at the moment. So no, I don't think it's more difficult. I just think it really depends on the business itself, what characteristics it exhibits, and which particular sector of service industry it's actually in.
Yeah, I guess if we had a discussion about moat, to use that sexy term, then I think it was Morningstar. Actually, it was the Morningstar. It's a great little YouTube program. But then the thing about the service industry is that they're certainly vulnerable to changes in technology. A lot of stuff being delivered, particularly over Zoom and what have you. And there's a lot of changes in that industry. But look, I'll just go to. I've just got a message here from my producer. You're 38 minutes in, and don't forget you've got lunch. That's okay, because I've got lunch with one of these gentlemen, so that's all right. My last question is, and thank you very much, Warren. Really appreciate you asking that question. So thank you very much for that. It was a good question. My final question comes on behalf of one of my friends on Twitter, who is aspiring to a career as a business broker. So just wrapping up, Andrew, what would you say to someone who's aspiring to become a business broker?
I would say apprentice to someone who is really good. Learn the ropes working for someone else. Choose an industry to specialise in, because business owners really appreciate dealing with a broker who really understands their sector, and be a voracious networker. Voracious networker.
Oh, there you go. All right. What about you, Matt? What's your advice to an aspiring business broker?
Yeah, look, I would say recognise that you're not just someone who facilitates a sale and a purchase. You must be to be successful. You're going to have to be a trusted advisor. You're going to have to be prepared to sort of get in and do the hard yards and work with businesses to prepare themselves for sale, etc. And that's how you're going to get the best results. And that's obviously on top of everything Andrew just said, which I absolutely agree with.
Okay. All right, guys. Well, believe it or not, we've gone for 40 minutes, so that means time is up. It has been a fascinating subject to talk about. I really think that we are going to see 2021 by the time we kick up our heels at the end. It will have been the year of the M&A. So thank you very much to both of you, Matt Adams from the DCI Group. Thank you very much. And Andrew from Succession Plus. It's been wonderful to have you. And thank you very much to those of you who've lobbed us in a question. Hopefully we've been able to answer those well. Thanks for watching, and we'll talk to you all again soon. Thanks, gents. Cheers.
Thanks.
Thanks, Stu.